Hello and welcome to today's session. Learning Outcome, LO1. Understand the general principles of formation of a company in UK law. Today, we will explore a fundamental question in corporate law. How is a company formed under UK law? This session will guide you through the key principles of company formation, from registration requirements to the role of corporate governance. You will gain insight into the legal framework that shapes business entities in the UK, helping you understand how companies are created, structured, and regulated. By the end of this lesson, you will have a clear understanding of the steps, rules, and legal obligations involved in establishing a company, setting the foundation for effective corporate practice. Company law is a cornerstone of English law and the business economy. You will gain knowledge of company law's substantive and procedural aspects. Learn about setting up private limited companies and the role of corporate governance. This unit builds a foundation for professional qualifications. It also equips you with essential skills for employment. Setting up a limited company has its pros and cons. Advantages include limited liability and separate legal personality. Disadvantages involve complex regulations and reporting obligations. Understanding these factors is crucial for informed decision-making. Evaluate whether a limited company suits your business needs. Incorporation makes a company a separate legal entity. Governed by the Companies Act 2006, it allows a company to own property. Shareholders benefit from limited liability, protecting personal assets. This principle fosters entrepreneurship by containing risks. Incorporation is a vital step in forming a company. UK law recognizes several company forms. Private companies limited by shares are common for small businesses. Public limited companies can offer shares to the public. Companies limited by guarantee suit nonprofits. The choice affects ownership, reporting, and compliance. Forming a company involves submitting key documents. The Memorandum of Association confirms the intent to form a company. Articles of Association outline internal governance rules. Form N01 provides essential company details. Upon approval, Companies House issues a certificate of incorporation. Incorporation grants a company its own legal personality. The Salomon case confirmed this principle, setting a precedent. Shareholders enjoy limited liability, protecting personal assets. However, courts can lift the corporate veil in cases of fraud. This ensures accountability and prevents misuse. Every company must have a unique name. It must comply with naming regulations under the Companies Act 2006. A registered office address in the UK is mandatory. This serves as the official location for correspondence. Proper naming and registration are crucial for legal compliance. A company must appoint directors to manage operations. Private companies need at least one, while public companies require two. Directors' duties are outlined in the Companies Act 2006. Public companies must also appoint a company secretary. Directors ensure statutory compliance and financial accuracy. Forming a company in the UK is a structured legal process. It offers advantages like limited liability and perpetual succession. However, it demands compliance with reporting and directors' duties. The Companies Act 2006 ensures transparency and governance. Understanding these principles is vital for company success. Private limited companies are common in the UK. They are owned by shareholders with limited liability. Shares cannot be offered to the public. They are ideal for small and medium-sized businesses. This structure provides protection and credibility. This structure suits large businesses seeking public investment. PLCs face strict regulatory and financial reporting requirements. Transparency is crucial for maintaining investor trust. Companies limited by guarantee have no shareholders. Members guarantee a nominal amount if the company is wound up. This structure is ideal for nonprofits and charities. Profits are reinvested in the company's activities. It provides limited liability without share capital. Unlimited companies have no limit on member liability. Members are personally responsible for company debts. This structure is rare and used in specific situations. It offers greater confidentiality in financial reporting. Unlimited companies are not required to file public accounts. Community interest companies serve social enterprises. They operate for community benefit rather than private profit. Profits are capped and reinvested in the community. SITCs are regulated to ensure alignment with community goals. This structure combines social purpose with limited liability. Limited liability partnerships combine elements of partnership and company. Partners have limited liability based on their investment. Profits are taxed as personal income, not corporate tax. LLPs offer flexibility in management and profit sharing. This structure suits professional firms like accountants. Limited liability is a core principle in UK company law. It protects shareholders' personal assets from company debts. The landmark Salomon case established this principle. However, courts may lift the veil in cases of fraud. This ensures accountability and prevents misuse. Courts can lift the corporate veil in exceptional cases. This holds individuals personally liable for company actions. Situations include fraud, evasion of legal duties, and agency relationships. The veil is not lifted for convenience or insolvency alone. This ensures fair use of the corporate form. The Articles of Association are a company's internal rulebook. They define the rights and duties of directors and shareholders. Articles outline governance, decision-making, and profit distribution. They form a binding contract within the company. Compliance is crucial for legal and operational validity. Companies can choose between model and custom articles. Model articles are standard and apply by default. Custom articles are tailored to specific company needs. They may include unique provisions on voting or share transfers. This choice impacts governance and operational flexibility. Articles of association are vital for company governance. They provide clarity and prevent disputes among directors and shareholders. Compliance ensures adherence to the Companies Act 2006. Articles maintain investor confidence through transparent rules. They are the foundation of lawful company operations. In conclusion, this video has highlighted the vital role of company law and governance in achieving business success. A solid understanding of company formation principles and legal structures is essential for any entrepreneur. Mechanisms such as limited liability and the Articles of Association offer both protection and clarity, ensuring smooth business operations. Equipped with this knowledge, individuals can make informed decisions, pursue entrepreneurial ventures confidently, and navigate the UK business landscape with full compliance. Should you have any questions, you are welcome to reach me by text or phone on 07000 484 361,688. Thank you for your time, and I look forward to our next session.